Jason, welcome to Real Vision.
Thank you for having me.
Tell us a little bit about Strategas. Besides the fact of the name, you don't have to get into where the definition came from, but Strategas is what?
Yeah, so Strategas, we're a research firm that focuses on macroeconomic research, economics, policy, technical analysis, fixed income strategy, and it's also a broker-dealer. So in addition to research analysts, we also have sales traders and institutional salesmen. And basically what we do is we write reports on these big picture things, we publish them, and then we travel around the country and the world to tell institutional investors what we're thinking.
That's fantastic. And your role is?
I'm the chairman of the company and also the chief investment strategist, so I mainly focus on the equity markets, but try to also pull everything together.
And one of the founders.
One of the founders, that's right. Started in 2006. I'd worked with Ed Hyman for about 15 years at a place called ISI Group from 91 to 2006. And then my partners, Nick Bonesack and Don Rissmiller, they joined me and we started Strategas in 2006.
That's fabulous. I want to start off talking about the markets overall, the equity markets. And one of the things that stood out to me, and key reason to discuss with you today, is earlier in this year on CNBC, one of the hosts there was pressing you and Rich Bernstein. Okay, where's the market going to go? What's the price going to be at? Where are we going to end up? You know, that kind of thing. And Rich kind of demurred, okay? But you said, all right, I'll give you, and you gave a number. And the number was, I think, for the S&P, which was at the time around 2,600 or something like that. You said in the neighborhood of like 3,000. In fact, you gave a specific number, 3,005.
Yeah. Oh, wow. Okay. So that implies a certain expertise I don't have, but at least I was bullish. At least that was in the right direction.
Yeah, right direction. Yeah, definitely. And the amplitude of the move was pretty close to it. Okay, so here we are coming to the end of 2019. All right. Where do you see the equity markets today? Valuation was tough before.
Yeah.
Even more so now?
You know, the hard part now is the market's not cheap by any normal standard. It's not. I don't also think it's particularly expensive given where interest rates and inflation are. So we're using, just to use round numbers, about $175 for S&P 500 operating earnings. If you put an 18 multiple on that, which I think is fair, given where, again, 10-year Treasury yields and inflation is, it would tell you the market right now is fully valued, but not overvalued.
Right.
The issue...
Not CAPE-like overvalued.
Not CAPE-like overvalued, and I'm not sure I'm a big fan of CAPE, frankly, especially with interest rates this low to begin with. But you know, we were talking this morning we have a morning meeting every morning at 7:30 where we all get together and we discuss the market's direction and what's happening. And our view is largely that if we're going to be wrong on the market, it's likely that the market's going to continue to strengthen more than people think. That markets rarely stop at fair value. They tend to get overvalued before bull markets end. And even though, again, it's pretty fully valued right now, with the Fed on hold for most of next year, it's certainly hard to be short. It would be my view.
So earnings looking pretty good going into next year, at least the next 12 months.
Right.
In any event, interest rates being low, that suggests to me that you guys use something along the lines of a discounted cash flow model for valuation.
Yeah, I mean, we do the earnings on a bottom-up basis, really from a sector level, so not bottom-up all 500 S&P 500 companies, but we do it sector by sector, and we build it up from there and come up with an earnings estimate for the year. And then we use a variety of econometric models to forecast the multiple. And you know, frankly, right now the models spit out what I would say was almost socially unacceptable numbers. 20 or 21 or 22 times earnings, just because you have secularly low interest rates and inflation. So we don't want to bite on that too much because it's generally speaking, it's hard to get a multiple more than 19 or 20 on a sustainable basis. But by the same token, 18 or 19 is perfectly reasonable.
Okay.
And again, we'd rather be a little cautious and be wrong by the market moving up the other way as opposed to being too bullish and have the market go the wrong way.
At an 18 multiple, that sort of sounds a little bit like the rule of 20.
Yeah, that's a fair. The rule of 20 is was created by my old boss Jim Moltz, and he had found over a long period of time, that if you added up the multiple, the S&P 500 and inflation, that on average the sum of those two items equal 20 over long periods of time. And we have very sophisticated models that look at all sorts of things, and then we have this rule of 20, and I'd have to say that the rule of 20 is just as good as some of the very sophisticated econometric models, and they're largely getting at the same thing, though, which is largely the idea that when you're discounting cash flows by lower interest rates, the net present value is quite a bit higher. That's largely what it's getting to.
Yeah. Now you referenced the Fed and low interest rates and all. Where do you see rates going into the next year, which is a big factor all the way around, economically and the financial markets?
Yeah. Well, short rates, in my view, are going to stay in the current range, right? So the Fed just met last week, the second week of December. You're going to be between 150 and 175. The Fed has made it pretty clear, too, they're not going to change until inflation is above 2 and looks like it's going to stay above 2%. Right now, with inflation about 1.5, a little more than 1.5, that doesn't seem to be likely anytime soon. So I think the Fed is done for next year. Long rates, on the other hand, though, I think should start to drift higher. Frankly, I think it's a good thing if they're drifting higher, because it's a reflection of real GDP growth as opposed to inflation. It's hard to forecast inflation right now, in my opinion. And so our expectation is that a stronger global economy next year will allow interest rates to move higher. And that actually winds up being good for S&P 500 operating earnings, because a steeper yield curve tends to be good for financials.
And that yield curve being more positively sloped is a reflection of an economy, U.S. and worldwide, that's in better shape?
That's in better shape. That, again, you have decent growth with low inflation. So it's really a Goldilocks. It's a Goldilocks type scenario. And I think, again, next year is an election year too, as if we can't forget. But Fed probably doesn't want to be too involved. It wants to be less involved than it has been over the last 2 years. Probably doesn't want to get the president involved if they don't need to. And again, they're in a position now where inflation is so tame that I don't think they have to worry too much about inflation getting away from them, running away from them, and they can take their time with the next move.
Tell us about the political scene, because you guys cover that as well. Dan Clifton.
Yep, Dan Clifton.
Down there in Washington, and what's your firm's perspective on that? Implications economically and implications for the markets.
Yeah, we've been and I was saying before, we've had plenty of bad calls, but one of the good calls we've had was on this idea of populism being something that can last. And we were pretty early on in taking Donald Trump seriously as a presidential candidate, pretty early on taking Brexit seriously as a potential outcome. And we're still very much of the view that populism is an enduring political theme. One thing I feel strongly about is that whoever the next president is, it will be a populist. And the question is it the right of center populist that's in the presidency now, or is it a left of center populist like a Bernie Sanders or Elizabeth Warren? I think for the time being, the days of having an establishment candidate are probably pretty unlikely. In my opinion, and I think it's largely reflective of concerns that everyday people have that are not largely and have not really been met by the orthodoxy of the bigger parties.
So that argues against someone like a Joe Biden.
Like a Joe Biden, in my opinion, if he may very well win the nomination, but I think if he ran against Donald Trump, he might have a decent chance of beating him, but I think Donald Trump would win. Listen, incumbents have a hard time losing anyway. Incumbents particularly have a hard time losing when the economy is as strong as it is now. Now, there's 10 months in...
And any number of things.
10 months is an eternity, especially these days in a 24-hour news cycle. So, our best guess is that the status quo will prevail, which is to say that Donald Trump will be reelected, that the Democrats will keep hold of the House and the Republicans will keep control of the Senate. That, in our opinion, that's the most likely outcome. But by the same token, it's a pretty 50-50 country, and anything can happen. So, but the economy, in my opinion, will be the single most important factor in terms of who gets elected next.
It'd be interesting to see what the consequences of that would be worldwide.
If Donald Trump being reelected?
That's correct. Yeah. In other words, 2016 wasn't an aberration.
Yeah.
It is what is.
Yeah. And I think, my opinion, Brexit, what's happening in Italy, what's happening in a lot of the regional elections in Europe, I think give you a pretty strong indication that 2016 wasn't an aberration. That there are a lot of kind of secular pieties on both the left and the right that have been followed by the establishment candidates, establishment parties, that average people are saying, this just doesn't work for us. And whether it's, you could go through, whether it's free trade with a country that's not really interested in free trade, like China, or open borders, or Affordable Care Act, or wars, endless wars, all of these sorts of things, average people, I think, are starting to question, and they want something different.
Yeah. Do you think that in the U.S., the Democrats, basically with their embrace of, let's call it the coastal elites, so to speak, and in particular, Wall Street and Silicon Valley, do you think that is a dynamic that's there that the Democrats are kind of missing?
That's my opinion, and I grew up in both my parents were Democrats, and I was a Democrat for a while, but it was a very different party at that point. It was largely for working men, working women. It was largely anti-communist. There was if you had strong religious faith, you didn't feel that you were necessarily excluded. The party has changed a lot now, and we could debate those things, but I would say there's a lot of people who have those opinions now that might not feel that at home in the Democratic Party, and I think that's one of the issues, and I think that's part of the reason why Donald Trump won. He recognized that and recognized that there's certain longing for something, and that's why I think Joe Biden would probably have the best chance of beating Donald Trump, because I think he has that everyman type appeal. I think he would have a better shot at winning than either Sanders or Warren.
How do you blend longer-term trends and themes with shorter-term business cycle-related issues? How do you mesh the two together? Because I get a sense that you do that.
Yeah.
You do look at both.
Yeah.
And how do you develop that into an investment methodology?
Yeah. Well, that's a great question, because it is a constant struggle, and it's mainly because our clients are professional investors. So to be frank, the main thing we're trying to get first is the next 6 to 12 months, right? It's trying to make sure our clients stay employed, and and in turn
That's a great point. That is a great
and then
point.
kind of in turn keep us employed, right? Because one of the hard parts about the investment business, particularly when it comes to stocks, is stocks are the longest duration assets you can get, really, or maybe aside from real estate. And yet, most people who manage stocks are managed on at best, are evaluated on a once-a-year basis. And then some hedge funds are evaluated on a monthly basis. So it's an almost impossible task for the professional investor today, in my opinion, that they, again, are trading in very long-duration assets, and yet they're held to this very short-term standard. So we try to give the longer-term themes, and we publish separate reports on longer-term themes once every quarter, where we try to give people, say, these are big long-term things to think about, whether it might be populism, or whether it might be the convergence between the public and private equity markets, or very, very long-term ideas. We publish those on a quarterly basis to make sure people know what we're thinking about those things, but we also publish every day about what's happening every day and what we think is the most likely outcome, on a shorter to intermediate time frame.
See, I think that's one of the great value propositions of Strategas, is the fact that you do reconcile the long-term framework, so to speak, with the short-term practical elements of it. I mean, what you said before about professional investors, that they're Yeah, they're judged on a shorter term basis. They're in long duration assets for the most part, judged on a short term basis in many cases.
Yeah.
Which is a difficult balancing act to do. And the thing that I've always been struck by is that Strategas, my sense is that you guys have your ear to that ground better than pretty much anybody.
Well, it's a very nice thing to say. It's actually, in my opinion, it's one of the great compliments you could give our firm. And I think it's if we do that well, it's largely because we, for better or worse, we travel all the time. Meaning, I'd say for worse because I have to go through TSA and LaGuardia Airport, and for better, once you get to wherever you're going, I travel 70, 75 days a year, and we'll be in everywhere from Des Moines to London to Singapore to and
your
Dallas.
Partners travel.
My partners travel more than I do, if you can believe it. They're a little younger than I am. The good thing, the bad thing about that is it's time away from your family, and it's not easy physically. The good thing, though, is that you meet a lot of different types of investors, and not just hedge funds here in New York. But you also meet, mutual fund managers in Boston and state pension plans in the middle part of the country, and then you might deal with a big bank in Europe or big public pension plan in Australia, those types of things. So you have a good idea of kind of where people are positioned and how people are thinking, and it keeps your mind fresh too, because you're not just talking to each other, which is one of the biggest risks in the investment business is you just spend a lot of time talking to other people that have the same ideas you do, or similar backgrounds or similar circumstances.
So how do you factor that into, or do you not factor that into your estimates of where the financial markets will be?
Well,
that dynamic of what they're thinking, et cetera.
Yeah, I wouldn't say it's not certainly not. There's no mathematical way we do it, but we do meet every day as a firm. We have a morning meeting, as I said, at 7:30 every morning, and we share all the time what we're hearing from the road and the questions that we're being asked by investors, and that the questions that we're being asked by professional investors inform a lot of our written work. Because, if you spend a couple of days on the road, let's say in Texas, you'll find that you'll get, the same 2 or 3 questions in almost every meeting. There's something that's on people's minds, and that will be the basis for the next report. We say, all right, we should look into, we might not know the answer, we'll likely not know the answer, and then we'll do the research, and we'll say, this is actually what happens. This is how long it takes between the first Fed easing and the next Fed tightening on average. How long does that take? Or a lot of things along those lines. What happens when the dollar strengthens or when the dollar weakens as it relates to earnings or sector weightings or things along those lines?
And that then gets fed back into the decision process?
Exactly.
What happens if you had a view, a consensus view, let's call it out there, of professional investors, some of which may carry more weight than others in your mind in terms of their insights and their views? If that is in conflict, let's say with the fundamental valuation work that you've done, with maybe the technical market intelligence that's there, what happens with that? Does that tilt? You say, oh well, we believe this, but this element here is a dynamic.
Well, I have to say, as always, as a basis for all the things we do, I have to say I've been doing this long enough to know that you have to be humble in this business because it's a very humbling business. So we never pound. I would say the style of the firm is decidedly never to pound the table on anything. We are always thinking about ways when we put on any sort of new call. Before we put it on, we think about how we might be wrong, right? And what would cause us to change our mind before the trade is put on or before the idea is established, because it becomes important because you want to be able to recognize when you're wrong quickly, as opposed to just trying to paper over it or make other excuses for it. But our clients, mercifully, our clients give us a lot of benefit for showing our work. Like as long as it's well thought out and well reasoned, our clients cut us a wide slack when we're wrong. And again, we try to have this discipline of when we are wrong, admitting it quickly and moving on and getting onto something where we might have an edge.
That comment reminds me of something that Byron Wien from Morgan Stanley days,
Right.
once said at a CFA market forecast event that I did, when he was asked the question, why are we doing this forecast for the year ahead? And he said, it's not the specific forecast of the number, it's the process that you put into it and understanding. And that sounds like what you're
Yeah,
describing.
I think that's right. I think Wall Street or in the investment business, it can, sometimes for people who are not involved in the business, it can seem rather dry or very uncreative. And yet I think the investment business in many ways is one of the more intellectually stimulating businesses there can be, because virtually everything can have an investment implication.
Sure.
It can be a very creative business in its own way. And if you're a news junkie like I am, you spend a lot of time learning about all sorts of different things, not just political events, but scientific events or social movements. All of those things can go into how you're thinking. And so it's important. I kind of view it that way, as something where you're constantly learning and trying to test your thesis and all the rest.
Mm-hmm. Social science with money.
Yeah, I think the problems, it is a social science, and it's the problems in the financial markets come when people try to make it a hard science.
Right.
I find that's when people, like long-term capital, tried to make it a hard science. People that packaged mortgage-backed securities and credit default swaps, they tried to make it a hard science. Sure. You put a little bit of beaker A into beaker B, and it equals beaker C, all the time. And the thing is, when you're dealing with human beings, it doesn't work. It doesn't work that way.
Doesn't work that way.
And that's one of the things I have to say worries me a little bit about this Fed. I feel more confident in. The past Feds, the Bernanke Fed and the Yellen Fed, frankly, I worried quite a bit that they viewed their role as really almost as chemists or hard scientists, where if you do enough of one thing, it will always turn out the way you expect it.
Sure.
And it just doesn't, when you're dealing with human beings, of course, it doesn't work that way.
I want to get to a couple of actionable items and areas that your firm is looking at. But before we do, I'd like to get your views on private equity. Quite a bit of money is going in that direction. Institutional investors are shifting money more so than at any point in the past into private equity. Yeah. First, what's your view in general of private equity as an investment vehicle, alternative? Yeah. And then secondly, I'd like to get your thoughts on what you think the motivating factor might be for institutional investors going into private equity that might include the whole issue of required rates of return and not being able to hit it when you have interest rates at 2% and 3%, and you got mark to market with that, and then you have private equity that's out there. So your thoughts on private equity in general?
So
first.
and I have to say, in terms of just being frank about it, we have no private equity clients, right? So consider the source. All of my clients are public equity or public market clients. So I want to be fair or just tell you where my biases might lie. But I'm very skeptical about private equity, the future returns of private equity being anything like what they were in the past. David Swenson really put private equity on the map in terms of an institutional asset class. And what he discovered was that there was a discount for illiquid private companies, or that there was a liquidity premium for publicly traded companies. And he says, I can buy these assets and I can buy them in the private markets at a discount, and eventually they'll either be public and so on, and I'll make a lot of money. And that made a lot of sense. He made a lot of money doing it, but of course he was the first person to do it. Now you're 25 years removed from when David Swenson really started doing that, and there are now 7,000 private equity funds that have about $3 trillion in assets. And so, in my opinion, you're running out of, and valuations, in my opinion, are not cheap anymore. I would argue that there's actually an illiquidity premium now over the public markets. Part of this, and this gets into your second question, which is why are people throwing so much money there? Frankly, I think people are chasing performance. And I would also say that there's an opacity of the private markets that is very appealing if you don't want to be embarrassed or fired. And not to be overly cynical about it, but your average public pension plan has an investment return assumption of 7.5%. Very hard to do that when 10-year treasury yields are below 2%, and the long-term average returns of public equities are 7%. pretty hard to get to 7.5. The only way you can really get that is through leverage. And that's what private equity provides. And also, though, it provides the best kind of leverage because it moves much more slowly. The marks move much more slowly, and so you're more unlikely to be embarrassed again or fired by having very outsized allocations to private equity.
That aspect that you brought this up several times now, that aspect is, I think, really underappreciated by many investors. That dynamic of the potential of career suicide, of getting fired, it's almost as though, okay, I've refrained from saying this or making this connection, but it's just such a fun thing, I think, to do. CFA equals CYA.
Yeah. Well, listen, I think all of us, and no matter what line of work we're in, job number one is keeping your job, right? I mean, I think that we're just human beings. We're all part of the same hypocrisy,
That's so
right?
great. Yeah.
And you have to just recognize that and try to use it to your advantage. And it doesn't mean that we're all. No. It doesn't mean we're bad people, but
no nefarious reasons.
There's no nefarious reasons, but there is a reality of the institutional investment business, which. Again, has careerism as a central part of it, just like anyone else in any other profession has the same tensions. This just happens to be with other people's money, so it's a little different.
That's so great. Great point. Last item, actionable ideas, sector tilting, style investing, asset allocation.
Yeah.
Give us some thoughts on Strategas' view, where I might want to be for 2020. We had Rich Bernstein on the program here a couple of months ago, and late cycle investing was his thing that he was emphasizing. Your thoughts on where we're at and where we ought to be as investors?
Yeah, I would say in that regard, we have a little bit of a different view, I think, than Rich, in that I'm not convinced we're as late cycle as it might seem. I know the business expansion is 10 years old, so it might seem late, but I also think the real Fed funds rate is 0, and usually what ends recoveries is the Fed killing it. Inflation rises to the point where the Fed killing it, and here, because of financial repression, you're pretty far away from that. So what we're telling our clients to do is to get more cyclical. So we've told them to really get more. We told them to buy financials. We're overweight 4 sectors, right? Financials, industrials, technology, and telecom.
Wow.
And so we're of the view that actually next year the global economy will pick up. And that's largely because a lot of the trade tensions will largely be behind us, at least as far as it relates to business confidence. In my opinion, the trade war, in some ways, it sterilized some of the benefits of the tax cut that you got at the end of 2017. That was good for capital spending for a year, but then it faded because businesses got scared because of trade. If trade is behind us, there is a chance that business confidence picks up, capital spending picks up, and also global economic activity picks up, and that should be good for those sectors.
And anything in terms of any thoughts in terms of the global markets, emerging markets, frontier, Europe, China?
Europe, in my opinion, is probably as more of a trade or tactical approach, let's say for a year, 6 months to a year, as opposed to secular. I like Europe quite a bit because in some ways, I tend to think it almost got hurt the most between the tensions between China and the U.S. just because it's so trade oriented, it's so geared towards trade. It should benefit the most if global growth starts to pick up. The question will be longer term whether Europe makes the structural changes it needs to pave the way for long-lasting growth. But for next year, at least, in my opinion, Europe looks quite good.
That's terrific. Thanks so much, Jason.
Thank you. I appreciate it.
And all the best in the year ahead.
Thank you. Thanks a lot.
Great.
Thanks for having me.
Thank you.
I appreciate it.